Hey everyone, welcome to another episode of Punch Card Investing. I think this is episode 7. So we're already 7 weeks into this venture, which has been great. And as you can see, we are down 2 members this week. Karan is feeling a little bit under the weather, so we wish him a speedy recovery. And then Brad is out on a trip right now, so he will be missing this episode since he's on the road. So they should be back next week if all goes well. And then we'll get our crew back. But that doesn't mean we're going to stop putting out that value investing content, because we got a good topic this week. We're talking about capital allocators and managers and who runs great companies and how what makes a good manager in a company, because ultimately that's who's steering the ship. So it's obviously an important consideration to make when you're investing in any company. So we definitely wanted to talk about that. But before we get into that, as a reminder, be sure to smash that like button, smash the subscribe button, and check out the Discord in the description below to join that. And we have a lot of great people on there talking about all things value investing, stock ideas, tearing down stock ideas from some people, and just kind of working through the investing research process. A lot of good content on there. So check that out. Again, that's in the description to the Discord. All right, guys. Who wants to go first in talking about a great capital allocator, a great manager, and we can get this thing going?
Well, Tom's probably doing the best of all if you want to jump into him first.
Got the goat, Tom?
Yeah. You guys were coming up with all sorts of interesting ideas about great managers, and all I could think of was Warren Buffett. So I'm gonna be basic and stick to Warren. I think you could probably, people have written several books on Warren Buffett and capital allocation, so we could be here all day doing like a 24-hour live stream or something talking about Warren. But I thought I'd pick kind of a couple of key areas. I guess everyone is familiar with Warren Buffett for his investment prowess and, picking great businesses and all that sort of stuff. But I think there's other areas of capital allocation that kind of fly under the radar a little bit for Warren Buffett, which are pretty close to as powerful. So I guess the big one that probably most people do know is the use of float from his insurance businesses. So I guess one of the things that Buffett has always been kind of wary of is using debt. So he hasn't typically borrowed a lot of money to make investments, but he has used float, which is has a few kind of similar characteristics in a lot of ways to debt. So basically float is what an insurance company, or the term that's used when an insurance company basically holds premiums while they're waiting to potentially pay out on policies. And that's kind of been a lot of fuel on the fire for Warren Buffett to have more capital to invest. It's similar in a lot of ways to investing debt, like I say, except he's effectively borrowing at very low, if not negative, interest rates, because the insurance companies are also kind of making money in their insurance business as well. So that's one of the examples of something that Buffett has done, and that's kind of been fuel on the fire for a lot of Berkshire's returns. I've seen some interesting research kind of stacking up what Buffett and Berkshire's returns would have looked like if they were just investing purely their own equity versus if they, what they've done with the float. And the differences are actually quite dramatic. They've been able to kind of leverage their returns on equity in a lot of ways by using that float. So that's one example of something that I find really interesting that Buffett has done. The other thing that I think, again, flies under the radar a bit, but is maybe coming back to the fore now, is basically Buffett's use of his own shares. So we saw in the past 12 months that Berkshire Hathaway has bought back about $25 billion worth of their own stock, because presumably Buffett sees that as being very undervalued. And that's a pretty big acquisition, even by Berkshire's standards, if you think about it kind of in that context. So I think the Apple investment was in the low $30 billion range. Precision Castparts was around $30 billion, which I think is, again, one of their largest acquisitions ever. And here you have them buying back up to $25 billion of stock. And it gets talked about a little bit, but nowhere near as much as the exciting, investments in public companies. So He's used his shares a couple of times, so he's had the buybacks, and then you also have this example of in the late 90s, he actually used his shares as a currency to buy a business. So in the late 90s, you could make an argument that Berkshire's stock was actually quite overvalued. It was trading at approaching 3 times book value, which if you look at Berkshire's stock now, it's more like 1.3 times book, maybe slightly above that now, and that's kind of the threshold under which Buffett will buy back stock. And he actually used his shares basically as a currency to buy businesses when they were really overvalued. So again, that's just something that Buffett has, the capital allocation decisions Buffett has made that I think probably don't get all the respect they deserve. So that's a few from me.
To the float point, it really is like an interest-free loan of some sort. It's a way to leverage returns without really bringing on true debt. I mean, it is a debt because they have to have that money ready, of course.
Yeah.
But it's I think about his recent Japanese debt deal where he got 0% bonds or near 0%, which is just insane. And that's kind of the same thing he's been able to do with the float, really. He's got to be a little bit more conservative with it since he's got to be ready for the insurance business, but that's definitely a way to leverage those returns. And I don't know if other allocators would be as comfortable with it. You got to believe in yourself doing something like that, of course. And maybe someone who's arguably more conservative wouldn't. I wonder.
Yeah, well, Berkshire's an interesting example because a lot of insurance companies can't invest their float in the way that Berkshire does. So we have this example of Monash Probri a couple of years ago actually went out and set up a brand new vehicle and raised some money in order to buy an insurance company with the idea of basically cloning what Warren Buffett has done. And after he actually bought the insurance business, he basically came to the conclusion that it was a massive mistake because there's all these rules around what you can invest in. You know, you can't just buy 3 stocks with all your insurance float like a Monash Probri might like to. But since Berkshire's such a fortress and they have mountains of cash flow coming in all the time from other businesses, they're actually able to invest in things other than 10-year government bonds like a lot of insurance companies are kind of restricted to. So
exactly.
That's an example. That one business that is probably doing something similar would be a Markel. So that's a business run by a guy called Tom Gaynor. It's often called like a mini Berkshire Hathaway. So they're trying to do something similar. Tom Gaynor's like a value style investor as well. And that's a publicly traded business, which has done pretty well also from investing in the float. So yeah, it's super interesting. Like I said, it is pretty similar to debt. It's kind of like people are paying you to hold on to their money rather than you paying an interest rate on the loan because you're making money from the insurance operations, and then you can also invest it and capture the gains on it, which is pretty phenomenal. And you obviously can't get a margin call on it either.
So not quite, sort of. And if there's a bunch of claims outstanding, then obviously he's got to be ready there. So it still has to be liquid. But yeah, it's different than like if the stocks go under or for some reason and you invest too aggressively and gets burned. Like he does have some time to make it up potentially, but that time is a lot more random because you don't know when a claim's going to come up.
Yeah. And Buffett does talk about keeping a sort of base level of cash on hand for those situations. So if they have, they have what they call a super cat or super catastrophe insurance business, which basically insures against hurricanes and terrorist attacks and all sorts of things. So those are the kind of massive claims that could come out of nowhere. Like it's probably not that high a probability that Geico are suddenly going to have all these little auto claims that turn into this big, issue. But things like super catastrophes, hurricanes, tsunamis, all that kind of stuff, you sort of have to have a base level of cash on hand to deal with that.
Right. And to buybacks, I mean, obviously they've done a lot more with buybacks lately compared to maybe I think a couple of years ago. I don't know when the last time they did as many buybacks as they've been doing now was. What are you guys' opinions on buybacks in general, just as a tool? Because there's a lot of controversy around them. I think because in the bad examples of buybacks, you have maybe an executive whose compensation is tied to something having to do with the stock value. they might take out some nice cheap debt, and then we'll use it to buy back stocks to pump up the value, and then artificially boost it to then get whatever their share compensation trigger is. So that's kind of the big controversy. What are your guys' thoughts on share buybacks?
I think it can be one of the best capital allocation decisions that a CEO can make if they do it at the right time. The person I'm going to talk about actually has bought back more shares than anyone in history. So I can jump into that now if you want to.
Go for it.
I guess I'll open up a little bit more.
Yeah. Do you mind if I just add one more thing first?
Go for it.
On share buybacks in general, I guess if you look at the overall data on share buybacks, like you can objectively say that most share buybacks on average are poor decisions. Like you see the amount of share buybacks plummet when stock prices go down, and you see the amount of share buybacks skyrocket when stock prices go up, which is the exact reverse of what should be happening. And like you said, Jack, it's obvious. It's sometimes to do with incentive structures. So a good example is Tim Cook at Apple. So I think a lot of people were big fans of buybacks when Apple really started doing that in 2016, 2017 pretty aggressively. But the stocks run up so much and Apple sort of continue to buy back shares, and people are less convinced on the benefits for sort of remaining shareholders, I think, at these prices.
Sure.
And if you look at Tim Cook's compensation, it's very strongly linked to earnings per share, which is directly benefited by buybacks. So whether or not that's driving that decision, I don't know, but
probably.
I think incentives
certainly part of it.
Play a pretty big part. Yeah.
Show me the incentive and I'll show you the outcome. I've been using that quote a ton lately. Thank you, Charlie.
That's Munger, isn't it? Yeah.
There you go. And there's also buybacks. A lot of buybacks happen with tech companies when they're already diluting their share price and they're kind of just buying back to counter that dilution. So in that circumstance, there's no real benefit. I guess there's a slight benefit because your shares aren't getting diluted. But in that case, it's not the best capital allocation decision. It's when the shares are cheap and there's that excess capital that they have nothing else to do with. It's kind of got to be timed perfectly to really have a great benefit to shareholders.
Which is really what Buffett tries to do, and it seems to have done.
So he had the general rule, I think, to buy back below 1x book value. Yeah. And in recent years, I think he's willing to move that up. Like he obviously just paid about 1.2 or 1.3 times book. So, but still, no matter how you look at that, that's relatively cheap for a business like Berkshire.
Right.
Yeah, it was 1.2 and then was shifted to 1.3 times book as the threshold a while back. The idea basically is Berkshire, obviously when Berkshire acquires a business entirely, it goes on the books at exactly, the book value is sort of one for that business. And over time they have businesses that do really well and they have businesses that do really poorly. But the businesses that do really, really well, like a Geico, for example, they're never sort of re-rated on the balance sheet of Berkshire. So that's why you end up with this premium to book value as sort of what Buffett says is like the fair value for their holdings. So that's kind of the logic that he uses. But he's tried to get away from book value a little bit because they've, I forget his exact reasoning, but I guess he assesses the intrinsic value of any business by present value of future cash flows rather than, the assets that they've got. So
right.
All right, you want me to jump into mine?
Go for it, Frank.
All right, so I'm going to do Henry Singleton today, he's a bit outdated. Most people might not have heard of him. He was the founder and CEO of Teledyne from 1960 to 1986. Jack, I've put a link into the chat on our StreamYard, and it's just from the book Outsiders by William Thorndike, which pretty much covers the topic we're talking about today perfectly. It goes through the 8 best CEOs of all time. So pretty much I'm doing a summary of the chapter on Henry Singleton. So Teledyne, the company he founded, is an industrial conglomerate. So they have also an insurance aspect, then there's special metals, aerospace electronics, and even dental appliances, which I just found in the book, which was pretty random. But there's a lot of different small businesses. He graduated from MIT, where he earned his bachelor's, master's, and doctorate of science and electrical engineering. So not a business background per se. He's more of a mathematician. He programmed the first student computer at MIT as part of his doctoral thesis and won the think it's Putnam Medal in 1939. So that makes him the top mathematics student in the country, which is an award that Richard Feynman won as well. He also was 100 points shy of being a grandmaster in chess. So no matter how you look at him, he's a super smart, a genius guy, particularly when you move into his business career as well.
That seems to be kind of a theme, just as a tangent, with a lot of great leaders in general. They're usually multifaceted, multi-interested. Tom, I know you were reading Range recently.
I was just about to say that, yeah.
Yeah, great book for anyone who hasn't read it. Have you read that one, Frank? Range?
No, I haven't.
It's fairly new. I think it's a couple of years old at this point. But Range by David Epstein kind of goes into this thesis that in some areas, early specialization will work well. Chess being one of those things, actually, since there's kind of a finite amount of things to learn, and once you learn them, then you're good. But for more dynamic things, it's more helpful to have different perspectives growing up. One example he uses is Roger Federer, played a ton of different sports growing up, didn't specialize to tennis until his adulthood, pretty much. But he's one of the best in the world and has been one of the best in the world because he has this like dynamic tool set. Same thing kind of goes, you see it a lot with great leaders and CEOs. They have a lot of different interests. They maybe were in a completely different industry and moved over to a new one and bring that new perspective. So anyways, that's a tangent. Great book, Range by David Epstein. Go check it out if you haven't already.
There's another book that I guess is somewhat similar to that called The Art of Learning, and I'm blanking on the author's name, but he was also a chess grandmaster, one of the best in the world, like a child prodigy. I really forget his name. He's got a good podcast with Tim Ferriss as well.
Joshua Waitzkin?
Yeah, that's him, Joshua Waitzkin. Yeah, he was one of the best chess players. I think there was a movie made about him as well. And he talks about interdisciplinary learning, where if you master one thing, you can then go and apply it to something else. So later in his life, he took what he knew from chess and applied it to Brazilian Jiu-Jitsu and a few other things as well, where he also became super high level as well.
That's that is pretty similar to the overall thesis of Range. It really is kind of a response to at least the way I kind of read it. It's a response to Outliers by Malcolm Gladwell, which is a lot more about the 10,000 hour rule that maybe you've heard before, where if you just focus 10,000 hours into a particular skill, you will become a master, or approximately something like that. Well, Epstein and I suppose Waitzkin would argue, well, not quite. You can definitely give yourself a big advantage by having multiple different skills that you're working at the same time. And then you can maybe learn a different one faster because you already have some perspective elsewhere. You're not beating your head against a wall. Maybe you'll go around it because you have a dynamic skill set. But anyways, let's get back to capital allocation.
Okay, so back to Henry Singleton. So again, no matter how you look at it, he's a super smart guy, particularly in maths, and I guess you can apply that to chess. So it's that strategy-based learning, I guess. So he's most famous for his arbitrage acquisitions that he made, and probably even more famous for relentless buybacks. So I have it in the notes here somewhere, but I think it was about 90% of all shares outstanding he eventually bought back. From 1970 to 1984, he used his cash to repurchase, 82%, I had it just there. And then later on, they continued to buy it back. And even after he retired, I think they still continue that same approach. So I'm not sure the total percentage now, but it's a small percentage of what it once was. So after the buybacks, the stock price increased from $2 to $250. So part of the shareholder returns come from those buybacks. And the directors of the company, Wall Street, and the media all really criticized what he was doing for reasons like I guess Jack was talking about earlier. But even more so back then, buybacks were really not considered this way to generate shareholder value. So he was being critiqued pretty hard and just continued to relentlessly buy back lots of shares. There was a 4-year period where he bought back 64% of all shares just in 4 years. So that's pretty crazy.
Goodness.
Son.
Buffett once said, the failure of business schools to study men like Singleton is a crime, and that he's one of the greatest operators and capital allocators of all time. So coming from Buffett, that's in pretty high regard, I guess. Yeah. And you can see a lot of similarities between how the businesses are structured and the type of capital allocation decisions that they make. So during the 70s, some public companies, usually conglomerates, were trading at high PE PE ratios, as they were kind of a new form of business and they were pretty popular in the stock market. And whilst trading at higher multiples rather than buying back shares, he would raise equity, so he's selling shares and diluting, to acquire private companies at lower multiples. So that's the arbitrage situation he can take. So they were trading between 20 and 50 times earnings. They would raise capital at that price and then buy a company for, he never paid more than 12 times earnings. So there's that difference in price where he really took advantage of it. So if you pull up that link, Jack, I don't know if you clicked on it yet.
Yeah, I didn't get the link. Could you resend it?
It's in the chat. Tom, could you copy and paste it if that's all right?
Did you put in the actual chat or the private chat?
The private chat on StreamYard.
I don't see that.
That's so good. Doesn't matter anyway. It's just a couple of tables. So in the 1960s, when he was acquiring companies, he bought 130 different businesses just in the 60s, which increased sales by 244x. It increased earnings by 555x, but earnings per share was only 65x. So the 550 compared to the 65, of course, because he's diluting shares so much, but regardless, still growing the business super fast. So shares outstanding over that time grew by 15x and debt by about 30x. So although that's pretty high for shares outstanding and debt to grow, the sales and earnings far outweighed that. And then the years following that, so moving into the 70s, Teledyne started to become cheap and was trading about 15 times earnings roughly. Of course, varying over time, but a lot cheaper than they once were. And then that's when he started his relentless buybacks, eventually buying back, that 90% or so. On top of that, during that time, they averaged a return on equity of 20% or over 20% consistently, which Charlie Munger said, his quote is, "It was utterly ridiculous and miles higher than anyone else." Continuing into the 70s, he also began to manage a stock portfolio through his insurance businesses. So similar to what Buffett is doing. I'm not sure on the exact structure, but I can only assume it was very similar to Buffett.
Yeah, probably had some float in there for sure.
Yeah. So again, a contrarian move, he aggressively reallocated all the assets in these insurance portfolios, increasing the total equity allocation from 10% to 77%. He also invested over 70% of the combined equity portfolios in just 5 companies. So a very concentrated portfolio, which again at that time was certainly not popular, particularly when you're using insurance money to do so.
Yeah.
From 1975 to 1985, so a 10-year track record with that portfolio, the book value went from 200 million to 1.8 billion. So that's just another capital allocation decision where he excelled.
Right.
And then in the book, it talks about, so in Outsiders, where it talks about, Buffett's in there as well, and 7 others, he talks about one of the main measures we can take is the increase in shareholder price, because realistically, you can measure things like earnings per share or whatever else you want to do, but how much value they create for shareholders is at the end of the day the best thing you want to see from a capital allocator. So from 1963 to 1990, which is the entire time period that he was the CEO, 27 years, the S&P 500 compounded at 8%, Teledyne competitors compounded at 11%, and Teledyne itself compounded at 20.4% for that 27-year time period. So just for dollar amounts to give you an idea how much that's an outperformance, $1 in the S&P would have given you $12. $1 in Teledyne would give you $180. So 180 bagger in just 27 years.
And to do that for 27 years is the real impressive part.
Insane.
It's not like it was for 5 years. That was 20% for almost 30 years. It's just that's intense.
Yeah, so the combination of those acquisitions while trading at high multiples to really grow that business at an insane pace over 10 years, then they became cheap because he was doing such ridiculous decisions and kind of contrarian at the time. Now It looks back and seems like a genius, and it was, but at the time it wasn't that. They become cheap. He buys back all the stock, makes great decisions with his portfolio, and returns a lot of money to shareholders.
That actually brings up one of the one of the problems or the difficulties of being a publicly traded anything, in that you're at the whims of Mr. Market and the feelings and the politics of everything, quarter to quarter, even though you're in this for 27 years. So if one quarter happens to be bad, like, well, you got years ahead of you, and this might be part of a 5-year plan, a 10-year plan, or whatever. So short-term fluctuations shouldn't really bother you, but that's how the market operates. We get quarterly reports. It's not just annual reports or something like that. I know, like Elon Musk has said that he sort of regrets, or at least he did regret, taking Tesla public. Maybe not after this year with the amount of money he's been able to raise from it. But the way it just distracts from things sometimes. If you have a bad quarter, then it's like, the company's doomed. But it's just one quarter out of a long cycle that you're trying to have with the business. So that he was able to make those otherwise contrarian bets for that long and just push through all the negative fervor, it can pay off if you can get your board with you. If you own enough of the shares yourself, you can just do it yourself, I suppose. But that's a constant challenge with public companies.
Yeah. And Buffett has actually written before about he would love to see the reporting standards change from quarterly to only twice per year. And that's actually something that is pretty commonplace here in New Zealand, and I think with most businesses on the ASX as well, right, Frank? That
is it?
Companies are only reporting twice a year rather than quarterly, which is not as big a shift as just going private, but it's a whole lot less stress. Like by the time you get a quarterly report out, surely you're like got to be prepping for the next one already.
Yeah, it's kind of like campaigning for like a political campaign. It's like, all right, you get like a month or two to work on something, then it's on to campaigning again, because it's kind of what a quarterly report can be sometimes.
And businesses, they can be so seasonal too. So like the first quarter could be so different than the fourth.
It almost looks like they've
had bad results. But if you're looking over the whole year, or you can extend that even longer too, you can have a bad year and it doesn't mean anything long term. So it's hard to get a gauge from just a quarterly report.
Right. And just about every company and every consumer company, at least in the US, Q4 with the holiday season is almost always better than all the other quarters. So that can be misleading if you're like extrapolating that out to the next year. And then Q1 after that and the next year looks so much worse. You're like, oh, what's going on? They're shrinking all of a sudden. Well, no, it's part of, they were gearing up for that for the full year. You can't look at it that short term, at least for most businesses.
See's Candy is actually a really extreme example of that. I might be slightly off on the numbers here, but I think Se's loses money like 10 months of the year or something. And then holiday season comes around. Yeah.
I think there's a lot of companies like that in the US, private or public, that it's like Black Friday, Christmas, that's it. And if they don't, they go to zero maybe any other time in the year, in gearing up for that and that alone. And if they don't stick that landing, then they're out. That's especially for a lot of like e-commerce focused businesses. That's often how it goes.
Yeah, and it's interesting. Like, I guess this is sort of indicative of people's capital allocation skills as well. But often you'll have a business like See's Candy, and then the management team will, particularly if they're a public company, will all of a sudden want to diversify, as Peter Lynch might call it, into other businesses to try and get rid of the seasonal like fluctuations, rather than focusing on the really good business that they have and just kind of accept that that's the way the world works. They'll go into lower quality businesses in an effort to just help people sleep a bit better at night, or I don't quite know what, but that's that.
Go ahead.
Yeah, but C's in the hands of like a Buffett and Berkshire, that's never going to happen. You know, they're not going to try and make the business diversify into other things that would decrease its quality.
Yeah, because you want to do what you do best, and doubling down on that might be the better option than diversification, like you said. That's a good way to put it. Going into something you're not familiar with, and wasting time and energy there, and potentially losing money too. And sure, now you're less volatile, but you're also worse. So that's not a very good trade-off. But it's tempting because of the quarterly nature of the at least the U.S. financial system, but even semi-annual, you get run into similar problems because it becomes very, very, very much about politicking as opposed to results.
Yep.
or it's short-term results rather than long-term results, really what I should say, which is basically what politics is.
So we just had a comment in there saying Seas loses money 2/4 of the year. And a few other comments about some great capital allocators. I seen Diego talked about Mark Leonard from Constellation Software, which certainly was one of the best roll-ups of all time. I think that's in Outsiders as well, or maybe he mentions it in one of the other chapters. But yeah, there's a couple other good ones mentioned as well.
Yeah, Jeff Bezos is mentioned in there. I guess I should mention mine. I was whenever I think of great leaders in companies, I often think of a few people. One of them being the late Jack Welch, who passed last year I think it was in March of last year. So we're just over a year since his passing. But he ran GE, General Electric, from I think it was 1980 until about 2000. So about 20 years there. And here I can actually pull up the numbers real quick. Under his leadership, he increased the value of GE from 14 billion to 410 billion from 1981 to 2001. So 20 years. That's a 30. Is that a 30 bagger? 30 bagger in 20 years. With an already big company, 14 billion is no joke, especially back in 1981. I don't know what that is in today's dollars.
It's a joke. It's a joke now, but it wouldn't have been back then.
Now that's an unprofitable IPO. Like no problem. That's not even a tenth of an IPO. But still, he's been dubbed like manager of the century. All these nicknames. Has some really great leadership products out there. I read one of his books actually when I was in college, and that's how I was introduced to him. Because he's got a lot of great experience in running the company. But his being a big business, they were very diversified in a ton of things. GE does a ton of different products, still does, and that can be very difficult to juggle and manage. It's part of that sort of problem that Berkshire runs into, and many others. Once you get too big, it becomes very hard to produce outsized returns because in order to move the needle, you need a big deal or many, many, many small deals. And that just can be very hard to manage. You need people to run it, and then you're losing your margin there. But Welch came in 81, and his big focus was on eliminating bureaucracy and running a lean machine, which is very difficult to do in a company the size of GE, even at the time, and especially now. And his big focus was on reducing bureaucracy, getting people to be comfortable with communicating with each other, as opposed to going through some hierarchy or whatever it might be. And it paid off in huge ways. And he also was rather ruthless, especially at the beginning, in cutting out the fat and in even completely destroying particular departments in the business that might have been unprofitable or just weren't in the right direction. He wouldn't hesitate to get rid of it. That was another thing that marked his career, was that he was very quick to decide, this isn't a good decision. We're going to cut our losses and move on and focus on something else, which is a hard thing to do. We were talking about politics, in which is very much a thing for businesses too. It can be hard to make those tough decisions. There's people on the line, and you're going to get judged for sure, and for going through a short-term sort of hard situation, but it might be the best thing for the long term. And he clearly never lost his focus there. I think revenue expanded from, I had that number somewhere earlier. Revenue expanded from 28 billion to 170 billion, and profitability did as well. He did leave right at the peak of the tech bubble, so there might have been a little bit of extra valuation there at the end, but still definitely added tremendous value to GE through his efforts, and a lot of great ideas in there, but definitely more to the people focused. That just shows you that's what companies are. They're people first. And if you can't run people, best of luck to you running a business, because businesses are filled with people, and being able to move the pieces around and get people to perform at their highest is a hard thing to do.
Yeah. It shows, it shows how influential people can be in the success of a business, and how important management is. I guess GE is probably a good case study, which it's a business that really hasn't done that well since 2000, right? Particularly in the last few years. So
basically since he left, I think it's been on the decline. I think the previous CEO actually blamed Welch for the problems that he inherited, which is just kind of ironic, because it's like Welch's thing was about moving on. Owning the firing is one of his mottos. Just realize, hey, we didn't put this person in the right position. we just got to cut our losses and move on. It's not their fault. We didn't do it right. That's kind of the stance he took, which I think is a really good one. And then sure enough, the next CEO, I don't know if it was the next CEO or 2 CEOs later, he I think recently came out and blamed Welch after he died that like, oh, I was put in a bad position because of the people he appointed and I couldn't get rid of them. It's like, well, I don't know how much of that is true, but it just kind of is. It's ironic coming from the guy who's all about getting rid of people when they weren't the right fit, and then he's saying, "Oh, these people weren't the right fit. I can't get rid of them." Well, wait, that's kind of the whole point. You got to get rid of them. So I don't know if it was an unwillingness or if it actually wasn't able to. I don't know what the executive compensation packages looked like, but anyways, yes, it has not been as good since he has left.
There's a question in the chat, Jack, if you want to pull it up, from Entrepreneur Liberty. It says, question for Tom is how it starts, but we can all have a shot at it if you want. Can you see that one?
Yep, got it.
So
if you guys have other questions, start bringing them in. I'll try to get some of the ones that were mentioned earlier, but if you can put them down towards the bottom of the chat, that would be helpful.
And hit the like button while you're there.
Yes, smash the like button. Always. Smash it harder.
So he said, how would you analyze capital allocation decisions? Can it be reflected on financial statements? So just to start that off, it definitely is. Pretty much in the cash flow statement will tell you exactly what they're doing with this capital. The main capital allocation decisions, there's 5, I'll try to get them, but buybacks, dividends, reinvesting, acquiring a company, and there's one other main one. There you go, I got 4 of them. And they're all, you can find them all in the financial statements, but you could also just see it through the growth of the company. So whether it's the actual financial statements themselves or the investor presentations and other information the companies put out, you can see the type of returns they're getting on their investments that they're making. You can clearly see the buybacks on a cash flow statement or dividends as well, of course. So certainly it is in there. And it's a big part of assessing. The one way you can assess management quantitatively, I guess. Most aspects of management, you're looking qualitatively. But you can see the capital allocation decisions through the financial statements, of course.
Yeah, both are important for sure. Like the Welch example I gave was definitely much more qualitative, but then Frank, your example with Singleton was very quantitative, in that it was very numbers, it's very earnings multiple driven, and both are clearly worthwhile to look at. And a combination of both is the most wonderful thing, but that's very hard to do, of course.
And Singleton, for example, would have been a hard one to have qualitative aspects because he never spoke to media. He really was a private person. So it'd be hard to get his plan, his vision and everything of what he was planning to do. So you really have to look at those numbers and be able to interpret that's a good idea. And at the time, that would have been very hard to do because he was the first one to kind of do that type of approach, I guess.
And numbers are a good way to actually evaluate the qualitative aspects. Are they doing what they're planning to do? Are they sticking with something? Is there a trend that they're following? You can tell a lot about the qualitative aspects through the numbers. You just sometimes it can be a little cryptic, especially if it's a large sort of shift towards maybe a new industry or something like that. Or both are important for sure, but numbers are probably easier to gauge quickly.
Yeah, the areas I probably pay most attention to would be things like return on equity and return on invested capital. If they're making significant investments in return on equity and return on invested capital are declining, that's probably not a particularly promising sign. Although there are exceptions to that, like at a certain point, Berkshire again is a good example. You get to a certain point where it's hard to keep reinvesting at high rates, and if you want to keep reinvesting rather than paying out dividends, then you're probably going to have to get into some slightly lower quality businesses or more capital intensive businesses, in the case of Berkshire with the railroads and the Berkshire Hathaway Energies and that sort of thing. But return on equity and return on invested capital, I pay a lot of attention to. And then I guess the way Buffett would look at it is he sort of says, we give our businesses the capital they require to meet their own needs first, and then we look for other uses of capital. And that's when it comes into a few of the things that Frank mentioned around, are we better off investing in new businesses, or are we better off buying back shares or paying dividends and all that sort of stuff. So those are a few of the things I pay attention to.
Or just holding and building up the cash short even higher than it already is.
Yeah.
There's another question there about Michael Burry from Jesse Wood, if you want to pull that
Yeah,
up,
I was
Jack.
actually about to pull that one up.
Perfect.
Did you follow Michael Burry, and would you consider him to be a cigar butt type investor? I don't know, does he really have like a one singular philosophy you can really nail him on?
Well, I guess to quote The Big Short, he will look for value wherever he can find it.
Yeah,
whether that's in a cigar butt like a GameStop or
whether it's forwards or backwards too, it'd be on the short side or long side. So
yeah, for sure. So whether it's long, short, stocks, or some derivative of some kind.
He's got a bunch of Google options, I think, still.
Yeah.
So yeah, he's kind of all over the place, but intentionally, it's not random.
He definitely has parts of his portfolio that are cigar butts, as Benjamin Graham would use them. Like there's a handful of net stocks in the portfolio,
right?
But I don't think his overall portfolio strategy is to do exactly that. That's just one aspect of what he's looking for and where he can find value.
He's not stubborn. He'll find value wherever it is. That is probably the best way to put it.
Yeah, and I think there's quite a lot to admire with that strategy. Like I think a lot of people can kind of box themselves into a certain type of investment strategy and miss a lot of stuff. Whereas Michael Burry is, open to anything, to the point where he's going out again to, if you've watched The Big Short, he's heading to banks and getting them to make some sort of derivative that doesn't exist in order for him to make a certain investment. So I think it's quite cool that he's open to all that stuff.
That's something I'm not trying to do what Michael Burry's doing, but it's something I've really gone through, especially over the last year, coming from a lot of my energy was focused towards learning about real estate. And I'd say in the last year, a lot more of it has gone towards learning about stock valuation and valuing companies, which because it's kind of, there's a lot of similar values there. And I don't know what, and maybe next it'll be learning more about options or more derivative type stuff. You can learn the next area to that thing we were saying about like being dynamic. That takes a while to get there, but if you can learn a lot about an area that can translate over to another area, then all of a sudden you can do something like what Michael Burry's doing, where you can be comfortable with many different types of assets and still have a great performance.
Yeah, I guess the only other thing to keep in mind is there is a lot to be said for staying within your circle of competence. So
don't be reckless.
You can be open to things, but don't be so open that you get into stuff you don't understand, I guess.
The hardest thing is when you know just enough to be dangerous, which is, it's impossible to tell when that's actually the case. That's the frustrating part until it's too late. So that's the hardest thing, especially like in the YouTube world, where maybe you watch a video or two and you probably know more than the average person about something, but you just, barely anything about it. And you still got to go a lot deeper if you really want to have a fundamental understanding, most likely. And when you reach that point where you're actually know enough to not be dangerous, that's like that magical moment that you can never really pinpoint. So yes, definitely be careful. Don't be reckless. Be careful. Keep always be learning, and that's really all you can do.
And Burry's definitely probably the most contrarian investor that at least large scale managers that you know about. His approach is just so different. It's hard to even know what he's doing. Every position you look at, it's just something different. He
just shut down his Twitter. This is really hard to know now.
Like the way they portrayed his character in Big Short really matches his portfolio today. It's like very autistic and strange, and all these weird decisions he makes. So it's hard to follow. It's a hard one to clone, definitely.
Didn't he want to go to it was like med school, right? I think is what he wanted to initially do, and then he kind of I think
he is an MD, I think.
Oh, is he? Yeah. I know he had some sort of medical background before he kind of switched to stocks. So I might explain some of the weirdness, and that he wasn't this kind of milquetoast finance guy. It was like dynamic. It's kind of, this should be the new title of the video, dynamic managers or something.
And you actually can't fully clone Michael Burry because there's things that don't show up in 13Fs, like shorts, for example, which I imagine he's got a bucket load of those in the portfolio.
One would think.
And it's such a short-term strategy, like a high turnover approach, that by the time you see it, he might have already sold it. So it's a hard one to copy.
Jesse says he's a neurologist. I'll take your word for it. That sounds about right. Definitely a very cerebral guy, so it makes sense.
Interesting taste in music also. I'm just assuming The Big Short's accurate when I say that.
Oh yeah, I do wonder what was missed and what was intentionally changed, because it's never going to be a perfect copy when movies based on real stories. For some of the nuanced stuff, some of the big stuff is you can tell from history, but personality.
I really want to know whether his coffee cup collection is real. From all the banks that he visited, remember that?
Probably. That seems like too weird to make up. Though then again, there's some artistic liberties in a lot of films.
Yeah, you never know.
That's looking for another good question.
Keep throwing out questions if you have any, guys. There's one about from Cam K, Capital Software Tech versus Factories.
Yep. Software versus capital allocation, period. Software / tech versus factories making stuff / mines, etc. Pros, cons, moats, etc. That's a lot of etceteras. What's the question in there? Like,
is it the comparison between like how capital allocation works as a software tech business compared to mines and things like that? That's how I'm interpreting it.
Yeah. Okay.
It certainly would be a very different approach, as with every industry and every different business. So I guess it's part of circle of competence. You need to know why management would allocate capital in that way. So for a lot of tech businesses, like I said earlier, there's a lot of dilution going on. So then they allocate capital towards buying back shares just to counter that dilution. So that doesn't happen in too many other industries. It's just part of the incentives that happen in the tech industry. And I guess mining would be very different too, as they probably pile up a lot of cash, wait for the right opportunity, and then go into some type of exploration. But yeah, I don't know too much about that industry, so that one's hard to touch on.
Yeah, I guess maybe one of the other parts of that question is around like the need to keep reinvesting in the business. So you have people running factories, which can be clearly very capital intensive, and software businesses actually can be somewhat capital intensive if they have to keep rewriting code in new languages and so on as it gets outdated and that sort of stuff. But even within those things, there's, like I was reading a book this morning, and it was talking about basically deploying capital in order to keep your operations going. And even businesses that run factories can have very different needs for capital investment to kind of keep up with their competitors. So they use the example of like Wrigley's chewing gum or a Coca-Cola, which doesn't have to retool their factories in order to come up with new recipes for their products or everything each year. Whereas you've got maybe a business like a General Motors, which has to come out with, a new model of car every year or whatever. And that requires very expensive retooling, every time they do that. So even within the software industry or within more, factory type operations, there's very different capital requirements even within each of those categories. And
different labor expertise too, in addition to just straight up retooling and hardware and that stuff. You got to have the people to do it, which you were touching on as well.
So there's a few things you can look at in regards to that. So you could look at revenue compared to capital expenditures, which is just one metric to know how capital intensive a business really is. And then you can also, that goes into breaking down capital expenditures into growth versus maintenance. So depending on the industry and the business, that will vary greatly. So of course, like the factory type businesses would be fairly capital intensive, or a car industry, for example, very capital intensive business. And then on the tech side, they're very capital light businesses, which I tend to like more, not just tech, just capital light businesses in general. But yeah, that's another a few metrics you can look at as well.
Yeah, and also the capital intensive businesses, just because they're maybe not as good a business in terms of like a return on equity quite often, doesn't necessarily mean they're going to be better or worse investments. I think you have to make that distinction as well. Like, if you buy a Coca-Cola or an Apple or something, yeah, they have really good returns on equity, but you're paying many, many multiples of book value to invest in those businesses, where that might not necessarily be the case in a more capital intensive business. And you need to earn a return on the amount of money that you put into the business rather than the amount of assets that you're acquiring when you kind of buy those shares, if that makes sense.
Yeah, right.
And that's something that Buffett has talked about with his Kraft Heinz investment. He's talked about, I don't know the full details of that investment because there was Kraft and Heinz which merged, I think, but he basically talks about that being a phenomenal business in terms of earning, like, I think it's north of 50% returns on tangible assets, but he paid far more than the amount of tangible assets, so he has to get his return on his purchase price, right? So that's something to keep in mind.
And speaking of Kraft Heinz, just a tangent. I read something about the goodwill issue with the Kraft Heinz merger, and that they overpaid so much. Goodwill, for those of you who don't know, is this weird accounting move where when you do a merger but you overpay for the actual assets, you can add on another asset to balance the balance sheet. That's just goodwill, which is like sort of the idea is it's like brand synergy or something like that. That's the premium you're paying for the merger. But it doesn't really produce anything in itself, and it can be a huge part of the balance sheet. And I think it was a very large part of Kraft Heinz for a while, and they've been slowly whittling it down. But every time they do that, it's like a big negative to assets. So just be on the lookout for that. If you're looking at the balance sheet and you see a large amount of goodwill, that's what that is. It's not really a tangible asset. But anyways, that was just on Kraft Heinz.
If you're looking to take over a business and liquidate it, probably don't give goodwill any weight. Very
important in a cigar butt analysis for sure. If they have 100 million in assets and 90 million is goodwill, it's more like they got 10 million of real assets, liquid assets, or liquidatable assets, if that's a word. Here's a question: how much can a change in management impact stocks? Well, significantly. Examples of different managers setting new directions, good and bad. Well, we went over some good ones. Think of some bad ones, maybe?
Oh, what are some bad ones?
Trevor Milton and Nicola, that whole fraud scandal. That's, I don't know if that's capital allocation as much as just straight up fraud or light fraud, maybe not legal fraud, with the truck rolling down a hill with no actual electric motor in it. There's an example of how through great sales you can like really get your stock pumped. That's capital allocation, I suppose. You're putting a lot of effort towards marketing, but you got to have some substance behind that, unless you want it to come crashing down, or I should say, rolling down a hill.
So as for just change in management, I guess it really depends on the circumstance. If management were poor previously, you would want to change your management to redirect and change strategy. That would be a good thing.
Yeah.
But for a company like Kelly Partners Group that I hold, where Brett Kelly's a big part of my thesis, I wouldn't like to see him move out of the business. That would make me reassess everything. I'd really need to understand that the new CEO is going to follow what Brett Kelly's doing. I guess Berkshire is another example where Buffett and Munger aren't going to be there much longer, so you need to have faith in whoever new management is, whether it was, what's his name? Greg
Abel.
Greg Abel. So if it is him, when it comes to that day, you'd need to have faith in that new management team as well. But in that case, you can assume he's going to continue things as normal. But does he have the ability to allocate capital as well as Buffett? That'd be hard to argue, I guess. It's
kind of that, it goes to that central tenet of that Buffett has said many times before. I think it's Buffett or Munger, one of them. I think it's Buffett. You want to buy a business that an idiot can run, because eventually an idiot will run it. Like you'll take your cake when you can get it, when you have a great capital allocator. But if you're overly reliant on that, you could run into some problems when you get a average or even below average capital allocator in the future. Because if you're investing over 100 years, most likely you're not going to have this amazing capital allocator in the chair for that whole time, because you're going to have some personnel switches, and inevitably something's going to go wrong or just not as good. So you got to be ready for that. And hopefully the business itself is strong enough that it can stand up without having an amazing person driving the ship for a while.
Because even you go ahead, Tom.
What was I even going to say? I think that Buffett's definitely said that. That may have even been Peter Lynch initially that said something along those lines.
That sounds like something he'd say too.
But I think Buffett also said something like, I'm going to butcher this quote, but it's something like when a manager with a reputation, it's something like when a superstar manager encounters a business with a reputation for bad economics, it's usually the reputation of the business that persists. So you can have superstar managers with great track records come into terrible companies and it still doesn't work out that well. But every now and then you do have a superstar come in and turn it around, and often you can have terrible managers and great businesses and still have them perform really well just because the business is so good. So sometimes it's hard to distinguish.
There are some businesses that really funnel everything through the CEO brand wise, maybe not actually through the company. Like one that always comes to mind is Tesla. It's Elon Musk. If you removed Elon Musk, I don't know what would happen, but it seems like it would be pretty bad because they're in this growth phase, and he's not only, say what you will about him, he's got some flaws, of course, but he's done some amazing things with building quite a few businesses. And maybe to his detriment, he has so many different businesses going on at the same time that can be very difficult to run even one of them. But if you removed Elon from the picture, I can't really picture a situation where that would help in any way. I would imagine would hurt quite a bit.
If we take crypto as an example,
yeah,
they all got out of that pretty quick just because of these words. So.
Fantastic, easy example. Remove his tweets or add new ones that are not as good, and ta-da, the rug gets pulled out from under. So if it's anything like that for Tesla, I'd imagine its stock price would definitely fall. But I mean, as a business itself, in running that machine, that's not an easy thing to run because they're going through the growth phase, which is arguably the most important phase and the hardest one to get through. Maintaining it after the fact is a different ball game, but getting there is very difficult. Very few companies actually get there to long-term profitability.
Yeah. And I like to look for businesses that are founder-led. It's just one little aspect that's not crucial to my investment, but
right.
It is a plus. But you really have to assess that founder themselves. Like sometimes the founder isn't the right person to manage a public business. They might not have those capital allocation skills. They could just be a visionary and entrepreneur to get up and running. But then you might need someone else to really take it that next step. So I don't know. No, it's not always great to have a founder-led business, which some people do follow. And it was in 100 Baggers as one of the reasons for companies to outperform. But you have to be careful with that as well. You have to really know that CEO specifically.
Right. So sometimes the founder isn't a good manager, or is maybe a one-trick pony, is good at one thing.
So I don't want to critique Elon too much, but it could be the case that he is that visionary to get it up and running, but whether or not he takes it to the right place, it's really yet to be proven. And I could be wrong on that. He might turn out to be one of the best capital allocators and CEOs of all time. It's hard to know at this point, but he certainly has the visionary aspects. So
yeah,
with the businesses he's got up and running so far.
Exactly. That's a really good point.
He should issue more shares.
Yeah, he should be doing exactly what Henry Singleton done. He should be raising and acquiring, raising why they're so expensive. And if they ever get cheap, then he can buy back some shares in the future.
He is good, or whether it's him or his team, they have proven to be good at finding new ways to make money and with what they're doing already that kind of fits into it. For example, the solar panel business, just in addition to the stuff he's doing with solar panel research and with battery tech, like finding these kind of new avenues that do take a lot of that visionary aspect, but actually putting them into practice is difficult. And they've managed to do a decent job at those sorts of things. See how they do with auto insurance, auto lending as well, in addition to their car business. But they're definitely thinking a lot about where to make money. Just the question is, after you get past the visionary phase and the testing phase, can you actually scale it and then maintain it? That's another very hard part to do.
There's a question there from Brian McDaniel on cultural differences, which might be an
I wanted to highlight
one
that
to have a stab at.
Where is it? It's a good one for you guys.
Yeah, do you find any cultural differences between Australia? I'm going to lump Australia and New Zealand into this question. Yeah. Australia and New Zealand and American managers. Is there a pattern in behavior? If so, what are the pros and cons of each? I'd be interested to get your thoughts on this one as well, Frank. I think from what I can gather generally speaking, you find a lot more of these really high-profile entrepreneur type people in US businesses, I would say, rather than Australian companies. I think Australian and New Zealand businesses have this kind of entrenched culture, probably largely due to our taxation laws, to start paying dividends and distributing capital as early as possible. Like that was a long time criticism of the A2 Milk Company when they were able to, forgetting how they're going now, but when they were able to reinvest at really high rates within the business and, produce phenomenal returns on equity and keep growing and so on. You'd read articles in the newspapers here in New Zealand and it'd say all these great things about the A2 Milk Company, and then it would say at the end, but they haven't paid a dividend and so-and-so investor isn't happy about this. And that just doesn't make sense. So I don't know whether that's really a cultural difference per se, but those would be a couple of the things that are fairly high up the list when it comes to some of the sort of high-level differences you see.
Is there a lot of debt compared to U.S. stocks or U.S. companies?
Yeah, I think actually, I don't know if you have different thoughts on this, Frank, but I think probably Australian and New Zealand businesses are a lot more open to taking on debt in general. I don't know if, that's what I would say, but do you have thoughts on that, Frank?
Personally, I've never noticed a big difference between debt. It depends. Like we have very different types of businesses here in Australia. Like we're very driven by banking and then mining. So I guess if you're looking at some type of metric, our debt might even appear higher here in Australia because of the banking companies and some of the mining companies. I'm not too sure how that would look. But overall, like with the more comparable businesses, I don't think there'd be too much of a difference. But as Tom said about dividends, that's a big one that stands out on the ASX. Most investors in Australia are looking for a dividend-paying company. There's a lot of money in people reinvesting their superannuation or their retirement money for a dividend-paying company to live off, and even just the funds here in Australia like a dividend-paying company. And we have the franking credit system. So it's a tax advantage to do so as a business compared to in America, which is why our dividend yield is a lot higher than American companies. So usually I wouldn't want a dividend-paying company. I'd want them to be reinvesting that capital. But in Australia, that's kind of an exception to the rule because it's almost an advantage for them to do so.
I wonder how much different it'd be if, to the like tax policy point, if the Biden capital gains stuff goes through, which would raise the capital gains taxes up to normal income. That would eliminate the incentive to do maybe buybacks. And instead of doing buybacks, you might see more dividends in the U.S. potentially for that same reason of like, show me the incentive and I'll show you the outcome sort of deal. If it's more advantageous tax-wise to do dividends, which in some cases it is at below certain income levels. But in most cases for larger earners and larger businesses, the long-term capital gains tax rate is much less than income for most people. So that makes more sense. But if that's raised, I'm sure you'd see a shift in the culture, if you want to call it that.
Yeah, and there's a good comment there from Buggerlugs NZ1, which I sort of largely agree with about recycling managers. I've actually noticed that as well. There's a lot of these almost like professional CEO types that will
There's
sort
a
of
good amount in the US as well.
They'll sort of rotate around like various companies on the NZX and ASX, and it's kind of rare to find companies that have had a founder CEO for the last 30 years or something, whereas maybe it's just the sample size, but I feel like you see a lot more of those in the US.
Do you see a lot of people on multiple boards? Because I think there's actually a ton of that in the US where people will be on like the boards of 3 or 4 companies and large companies at that. Maybe obviously in different industries, but still.
That's pretty typical here in Australia as well.
Sure.
Yeah.
I've always thought that was weird. Just like, how do you like really, I guess if they're separate enough to where there's like no overlap, you could withhold your duty of loyalty to the company. But
I think sometimes companies like to have just a name sitting there that won't have too much input so they can get away with what they want to do more.
That's true. That's definitely true.
Yeah, that is true. And I guess you sort of already mentioned that there a bit, Jack, but related to the dividend point, share buybacks are extremely rare, I've found, in New Zealand and Australia as well. Like KPG like Frank was talking about, have been doing a bit, but it's not that common, really.
That would make
because of
makes
the
sense.
dividends, I think that it's kind of, we pay a dividend, they're more likely to buy back shares in America. I think that's probably the main difference between the two. And then, like Tom touched on as well, there's probably less entrepreneurial startup type businesses and tech-based type businesses that could be a high growth opportunity. I guess until the buy now, pay later sector here in Australia kind of took off. So there's a bunch of these smaller, I'll call them crappy businesses, but some of them have worked out really well. So
yeah, and it's at the point where if one of these, software entrepreneurial type people does start up a successful business in Australia, they'll go and list it on the NASDAQ. Like, it's at that point where they won't even consider the ASX sometimes. I think I was just looking it up, but I believe Atlassian is a good example of that. I think that was originally an Australian business, and I'm just pulling up the market cap.
I think that's the biggest Australian company, but it's listed in the US.
Yeah, $58 billion US dollar market cap on the NASDAQ. Ticker symbol is TEAM, TEAM.
That's a good one.
For Atlassian. Yeah.
How's that? There's a good, it's like a ticker symbol index with the best, catchiest ticker symbols that apparently has done great over the last 10 years. I wonder if that's on it.
Yeah, don't know. But I don't know if people just don't think New Zealand and Australia is big enough to raise enough capital, or quite what it is, whether they just want to boost their share price. I don't know. But we have seen a few examples of that. I mean, at a smaller scale, you sort of got like Australia and then New Zealand are almost like the next level down in terms of being able to raise capital. So we've had Xero, for example, are a large software business that was dually listed for a time on the NZX and the ASX, and then they went to the point where they just got solely listed on the ASX, and New Zealand investors received Australian shares in Xero. So there's a bit of that kind of stuff that happens too.
Most of the capital raising here in Australia is for mining companies typically.
That's pretty capital intensive too. Here's one more general. What do you look for when judging management aside from capital allocation? I mean, doesn't it kind of ultimately all come back to that? Like, it's just in one way or another?
Yeah, I'll jump in here because there's a example I can put out there. So I guess like just honesty and integrity is kind of one that I would look at, and that is obviously very qualitative, but one of the ways that you can do that is just reading how the management team talks to shareholders. Like, are they candid about their mistakes and where they've screwed up, which is something that will immediately leap off the page to you if you read the Buffett letters. He spends far more time talking about his mistakes. Like even this year, he talked about, how he overpaid for precision cast parts. And then he sort of like just quietly mentions that he made $100 billion on Apple or whatever it is, And the example I was actually going to bring up was with Fiat Chrysler, which is now Stellantis. So they, a couple of years ago, published like this 5-year business plan where they had very specific earnings per share and free cash flow targets and so on. And for the next 2 years, that business plan was barely mentioned ever again. So you occasionally see people put out these targets or whatever, and then it just kind of falls off the radar, and they don't even say why they're not talking about it anymore. Those would be some more qualitative things that I pay attention to.
So a couple of things I look for. Well, I'll use Brett Kelly, again, Kelly Partners Group, as an example. Just one thing I look for is insider ownership. I do like to see high insider ownership for a management team. But Bill Brewster or maybe Tobias Carlyle, one of them made the point about comparing that to net worth being pretty important. So if you own 50% of a company, but your net worth is 100 times higher than that, then it doesn't mean as much. But if someone like Brett Kelly, for example, who I don't know his exact net worth, but almost all the money he's made has come from Kelly Partners Group. So a lot of his net worth is into the business where he owns 50% of shares. Another little thing is just to read back and see the guidance that management were putting out and whether they've met that guidance in the following quarter, half year, or year, whatever you want to look at. And if they've consistently done that for 5-10 years, and then they're giving you guidance that they're going to grow 15%, you can take that as a somewhat conservative thing that they'll definitely reach. Like, it's unlikely they're going to suddenly be wrong if they've been consistently right in the past, which again with Brett Kelly has been fairly true. So he projects about 15% growth on the top line, which I'm taking as a conservative number just because of his track record.
I think churn, that's a really good point on the net worth. Like, kind of how much skin do you really have in the game is kind of what that's looking for. But another one with management to look at is there a lot of churn, especially recently? Like, are there a lot of new board members, a lot of new executives being moved in and out? Why is that happening? Is that because they're making some shift to something? Is it because there's maybe, to Tom's point about honesty, is there any fraud or something like that going on? So looking for recent changes is probably a good idea. If there's talks about someone leaving, that could be another one. Someone's maybe close to retirement, something like that. Saw it obviously with Seritage. There's some instability there, and that can throw a wrench into things if they're in the middle of a plan and that person's important to it. So you got to look out for some churn as well. By the way, everyone, I just put in our Discord link since apparently the one in the description, I think, is not working for some reason. So I just put an updated one in the chat. So go ahead and check that out if you're not already in it.
They do expire after 7 days unless you change it in the settings. Just in case
I did change it to never expire, but maybe there's one floating around that isn't. So I'll be sure to change it after this. Brad just showed up in the chat.
Kyle Seminara as a capital allocator. Are you guys familiar with Kyle Seminara?
No,
I am roughly.
I know a little bit, but I probably know as much as you, Tom, if you want to dive in first.
I don't know how much of a dive this will be, but he's the guy that's involved in like OpFi and that lumber company Mike Mitchell invested in, right? Are we thinking of the same person?
That's the guy.
Yeah, so I listened to a podcast where Kyle Seminara was a guest that Bill Brewster did. So the Business Brew is his podcast. My first impression of Kyle Seminara was that this guy needs a holiday because he sounds extremely overworked and tired. But in terms of capital allocation skills, I really don't know enough to give a good opinion on that. Sorry, Brad. But maybe when Brad's back on here next week, he can tell us all about Kyle Seminara.
Or make a video on him.
His very recent track record has paid off really well for Michael Mitchell, who pretty much invests in all the companies that Kyle has. So it's worked out well recently, as far as I know.
Yeah. Jack, do you want to pull up?
After Dinner Investor asks if Brad will be making a video on this video. That's something Brad would do.
It's the infinite monetization loop.
Yeah, we gotta get this channel monetized, everyone. We're getting close to subscribers. We're over halfway on hours, so keep plugging along. Appreciate all the support, of course. Which one were you looking at, Tom? What's that?
Yeah, I was just gonna say, if you could pull up a 5-year chart on Green First forest products. That's one of Kyle Seminara's entities. He's got a few, and that's what Frank was talking about with Mike Mitchell, making an ungodly sum of money on a lumber investment.
Yeah,
I mean, he was already at the point where he used to be an investment analyst, and $1 million a year bonuses weren't moving the needle for him. So he decided to just run his own money, and now he's fairly concentrated, and he's put a good chunk of money into this thing. And I don't know, I can't quite see the percentage on that, but it's something ridiculous.
200 bagger or so in the last year. not even the last year.
So that helps.
That'll do it.
Yeah.
Any other questions we can jump into?
There's a bunch in here. I just got to look through them real quick.
Yeah, I'm really liking the after dinner investors diet for tonight. That's not really a question, but
the most recent question from Brian, if you want to pull that up, it's pretty good.
If you only had to pick one capital allocator to invest your money with for the rest of your lives, who would each of you choose? I think I'd have to go with probably only because if it's the only one, I kind of need not just maybe one business, but I'd like to have someone with some diversification in there. So I'd probably go with Bill Ackman, who still runs a concentrated portfolio, but he's someone who can leverage a lot of good connections within the businesses that he owns and has done that before. So that's probably who I'd go with. And I'm a Pershing Square shareholder, so and it's a significant portion of my portfolio, so I'd probably go with him. Maybe he'll be the next Buffett. Everyone's the next Buffett, but we'll see what happens once Buffett's gone and if he can go on for another 60 years till he's in his hundreds or something.
Yeah, well, if Buffett was like 20 years old, then I'd say Buffett, but but he's not. So I'll go on today's ones. This isn't a public company, but maybe someone like Li Lu, even like if you could get access to Li Lu's fund, would probably not be a bad place to coffee can.
You got some endorsements there. You got some good endorsements there for that one.
Yeah. So depending how we take capital allocator, if we're talking about a fund manager, then I'd probably go someone like, I don't know, Monish Pabrai, something like that. But if I had to invest in one business, well, I have to go Kelly Partners Group because that's where almost 50% of my portfolio is. So if I was stuck with one,
you're already there.
I'm pretty much there. So
that was a good question. I'm trying to think of anyone else who I might have missed. If I'm going for like one business, I don't know if I could narrow it down on one business.
One business
for the rest of my
life. Yeah, Frank's gone super concentrated. Yes, I'm sort of like flowing through all the things I've ever learned about public companies to think of a business that is actually quite diversified in some way.
Yeah.
so that you can sort of
safety.
Yeah.
Sort of like a Berkshire.
It's like the classic Charlie Munger saying I only own 3 stocks, but it's like Berkshire, really. Costco, and Li Lu's fund. So
Berkshire, which has a bunch of businesses, Li Lu's fund, which has a number. It's like, really 3.
Sure, 3. Charlie.
Yeah. Sounds good.
I'll let that one slide.
Sure, Charlie. What have you done?
Yeah. That's a good one from Bradley Hope, using a bit of inversion.
We've been kind of touching on it. Can you use inversion to invert our theme, how managers would destroy a business through poor capital allocation decisions? We were talking about a little bit about with buybacks. That can get pretty reckless, especially in this low interest rate debt environment. It can be very tempting to take out 3% debt and then use it to do share buybacks just to trigger some executive compensation package. But you still have the debt after the fact. And if your cash flow can't meet up with it, that could hurt you in the long run. I think that's a pretty easy one to cherry pick.
Yeah. If you do the opposite of what Henry Singleton done, if you buy back shares while you're very expensive and then raise capital while you're really cheap, you're going to perform very poorly.
Yeah, agreed.
Yeah, just go read something on Carnival Cruise Lines or something. That's the answer to that question. And you'd probably also want to do the issuing of shares at the wrong time in a very cyclical business. You'd want to probably be in some sort of mining company.
Raise debt to pay a dividend. Do something. Yeah, you can do a lot of
raise debt.
That's very similar to doing buybacks on debt, which a lot of U.S. companies have done over the last decade. I like to blame somewhat central banks for that. Like, you've made interest rates so cheap, you're looking for returns, you're pushing people out the risk curve, and that ends up being one of the things that's very enticing for a lot of bigger businesses.
Yeah, and probably the diversification is one I'd throw in there. Trying to run a bigger business just for the sake of running a bigger business and being able to brag about your revenue, or trying to get away from the cyclical or seasonal nature of your core business, which is actually quite good. Kind
of on the other side of that, you can be too stubborn, and in a place where maybe you should diversify, you don't. That can be very harmful as well. If you're in a dying business of some sort, and you might have a short window where you still have some good cash flows, and if you don't reinvest those cash flows into something else, then the business is gone after a few years, or it's much worse. There's certainly situations where diversification, like, I think maybe not so much you, Jack, or perhaps you do. I guess it depends how you classify yourself, but we pretty much all run fairly concentrated portfolios. But there's examples of businesses where diversification is a must, and the more diversification you have, the better off you are, almost without exception, would be the case in like an insurance business. You can imagine
Imagine if Geico only had one customer, and that they're just printing money when this guy's driving well, but then he goes and writes off his car and suddenly you're bankrupt. So that's I guess like the absolute extreme example of a case where diversification is quite useful.
That's kind of like with the Equity Commonwealth deal that just happened with Monmouth Realty, that half the portfolio was FedEx distribution houses, so half their customer base essentially is one tenant, and that's risky. And sure, you might get decent returns in the short term, but you want to diversify a little bit over the long term, because now you're relying on a completely different business to keep doing well that you don't even run, and that can be very risky to rely on it over the long term.
Yeah, and if you're that reliant on FedEx, they've got a fair bit of bargaining power when rent review comes around, right?
Exactly. Yeah, you're not going to be able to jack up their rent because they'll just go somewhere else. They got plenty of properties. Here's a question from David: can a company have a high PE and still be cheap? I can answer that pretty quickly. I think definitely. It depends on growth. A company might have a very high PE right now, or even a negative PE, and they're not actually bringing in profit. But if they can grow at a substantial enough rate over the future, and it also kind of depends on your discount rate and whatever you're trying to get as a required return, it definitely could. It's different for every person, but certainly a company can grow, and that's the other side of earnings, is how much can the earnings grow over the long term.
I guess the way I look at it is, if the present value of future cash flows is significantly higher than the current price, then the PE really doesn't matter. It's coming to an evaluation of what the present value of future cash flows are, is the entire job of the investor, really. So you can obviously have very different opinions on that from person to person, but a lot of growth can more than compensate for paying a high, any sort of multiple, really, not just PE, price to book, or all sorts of stuff.
So I even looked at my portfolio recently. I was just looking at the earnings yield of each of the companies that I hold, so the inversion of a PE ratio essentially. And half of my portfolio seems pretty good on an earnings yield, but the other half doesn't, as I bought them at a high PE multiple, but on the assumption that there's underlying earnings there and the growth that will counteract that over the long term. But I guess it is a good typical rule to buy, like to consider these ratios and buy at low multiples, so you can get a return from multiple expansion as well, because essentially you get your return from the growth plus the multiple expansion, or business growth plus multiple expansion, and a dividend yield if they pay that as well. So I don't know, there's some considerations to really looking at these multiples and finding low multiple businesses, but there's always the circumstance where it doesn't matter as much.
Yeah, it's one metric of many. Speaking of metrics, we have fish stick here. Thoughts on BOFA as a fundamental indicator? Do you guys know what that is? Is that like?
Let me ask God Google.
Yeah, is that like?
I typed it in earlier when he first put it in there, and the thing comes up as Bank of America, but I don't know how that allies with fundamental indicator.
There's a BOFA's indicator. What does that mean?
Is that kind
anyone
of
in the
some
chat
kind
know
of
what that is?
Is that some kind of technical indicator or something?
A BOFA contrarian indicator that measures investor bullishness rose for the third straight month. So I think it's probably something having to do like with volatility, maybe.
Yeah, it's some sort of trading signal,
something like that.
So realistically, you don't want our thoughts because we have no idea.
Yeah, right. I hadn't heard of it. I don't know. Maybe if you can find some value there, go for it. But I certainly don't know anything about it.
Compounding Everything is in the chat, which is pretty cool. He's got his own YouTube channel as well.
Where is he?
Yeah, needs to make
a question. Yeah, he hasn't made videos in a while, as far as I can see.
But he's here.
Slacking.
Thanks for stopping by. You should be making videos, though.
Yeah. It's easy to bag on people when they can't reply, isn't it?
Yeah.
Compounding Everything except for his YouTube videos.
Ooh. Yikes.
Burn.
All right, we'll leave it on that one. To Gabriel here. Hey, folks, question for y'all. What is your take at investing in private equities or companies apart from the ones on? So just what's your take on investing in private companies as opposed to public? I don't really have that ability in the US since I'm not an accredited investor. I don't know if that's different in the Australian or New Zealand markets. But in the U.S., you typically do invest in private companies, unless it's like a arm's length sort of family transaction. You typically can't do it unless you have a certain net worth and a certain income. I think it's a net worth over $1 million or an income over I think like 200 something $1,000 a year over the last few years. So you got to be a wealthy person essentially to invest in private companies directly. Most of the time, there are exceptions, and I mean, check out the rules for yourself first before you invest in something. And I know I am an attorney now, but this is not legal advice. So
Yeah,
I don't really invest in private companies, mostly because I can't. I would like to in the future, though, since it seems like a very interesting space. If you can find a business that you think you provide some value to, or that just really has a nice low multiple, perhaps, and good
Yeah.
future projections.
Yeah, I think it depends on how you define like what you mean by a private business. Like you could almost consider like whether you're investing in some sort of private equity fund where you have to be an accredited investor, or whether you're just buying a laundromat down the street or a rental property or something. I guess I would probably analyze all of those things pretty much the same as I would for a public company. The only thing that you would consider, I guess, if it's like a rental property, you have the pro of being able to use leverage relatively safely, I guess, which you can't do in stocks. But then there's also one of the main advantages, particularly as a small investor like us, is if you buy into a public company and you realize you've made a mistake, you can reverse, you can get out of that very quickly and very cheaply, which
liquid
is very hard to do if you buy your local laundromat or whatever. I don't know what the daily trading volumes on laundromats in New Zealand are, but I imagine it's quite low. So it can be a slow and potentially costly process to reverse some of that stuff. But
real estate right now is on fire. You're pretty liquid right now in the US, but but it's still not nearly the same as selling a stock.
Yeah. So I mean, there's and there's pros and cons to both. Like I imagine you're likely to find a lot of low multiple businesses in the private market, which is potentially more challenging to do in the public markets, but also you're probably getting lower quality businesses on average. It's a bit of a hard one to judge, but I'd analyze it very similarly to a public company.
The difference is you have to factor in, typically you have to factor in so much more growth. You're not buying most likely in the private market, you're not buying a highly profitable. I'm talking about companies, not. You bring up a good point, Tom, about like a rental property or like any sort of private business that you could start for sure. I was thinking more like equities, but typically I think the way a lot of venture capital folks do it is they kind of they're playing probabilities. They buy a basket of, we'll just say 10 companies, hoping that one will stick, or even 100 companies, hoping that 1 to 10 will stick, and that one will outweigh all of the losses, because it's just so much more uncertain. It's usually more naturally, it's way more growth oriented in many cases. So because they don't have a lot of earnings, and the whole point is that they're in that visionary stage, they have an idea, they're trying to get off the ground. So it is a slightly different ball game, but the fundamentals, like you're saying, Tom, I agree, are ultimately the same. It's what's the discounted the present value of future cash flows of this business. It might be hard to determine what that is because it's so new, but that's ultimately the same game across the board.
Yep.
See,
After Dinner Investor has a good point about liking the manager to be literally the best person on earth to run that particular business, which is a very good point.
That would be helpful.
And I mean, Buffett has talked about Tim Cook a fair bit. Like, there's obviously things Tim Cook can't do compared to Steve Jobs in terms of creating new products, probably. But there's a lot of stuff Tim Cook can do that Steve Jobs might not have been that good at.
And plus, they got even more capital to work with than before, so that's a new challenge and a benefit at the same time.
There's a question in there about the SRG CEO, which I guess only Tom might know about. I don't really have much information there.
Just any update?
Yeah, so the new CEO is Andrea Olshan. There's a subscriber actually sent. So Brad and I have done a couple of live streams on SRG, and we did an updated one a couple of weeks or so ago.
Go
Maybe
check those
longer
out.
than that now.
They're
Yeah.
great.
So yeah, there's a new CEO, a subscriber actually. So there's very little information that's easy to find on Andrea Olshan. You can find, I think Brad managed to dig out like an unlisted YouTube video of a interview from 5 years ago or something, but it's obviously hard to judge from that. And she comes from basically like a family real estate business. So I guess if he had any initial criticism, it would be like, they haven't got there necessarily on merit, but again, that's kind of hard to judge without knowing a detailed track record. So I don't have too much to add really. The time and results will be will tell all. So that's going to be the true test of what happens at SRG over the next few years. One thing of note though, a subscriber actually a few weeks ago did send me some info on a hostile takeover that Andrea Olshan was involved with a few years ago, which, to be frank, did throw up some red flags for me. So it would be worth doing some Googling on that front and reading that through. I actually sent a note on that to Monish Fabrai and Guy Spear, and so I think Monish Fabrai gets like some sort of folder every morning with his daily emails from his assistant, and I got like a short handwritten note from Monish saying, thanks for the nice note, Tom. I have nothing to say on this, or I have nothing further to add or something. So nice to get a note from Monish, but yeah, it wasn't particularly
was it a screenshot of a note? He wouldn't mail it, would he? No way.
No, his so his secretary like scanned it and emailed it back. Like you could even see in the scan there's like the little outline of like a staple in the corner or something, So I got that sent through.
It's a nice souvenir.
Yeah. So maybe I'll put that on the wall in a video or something. I think it does have my phone number on it though somewhere. I was sort of quietly hoping he might ring me or something, but I might have to block that out if I put it on my YouTube wall. As much as I love talking to the subscribers, I'd prefer not to have 4 a.m. phone calls and things. So, but yeah, I'm going off on a tangent here, but
just crossed 25,000. So congrats there. That's awesome.
Appreciate it. Yeah, I'm going off on a bit of a tangent here, but that's my thoughts on the SRG CEO.
It's a good one. Speaking of Tom's channel, if you guys haven't checked out his awesome interview with Toby Carlisle, that was a great one. The author of The Acquirers Multiple and Fund Manager. That was a really good interview. So well done on that one, Tom. But definitely go check that one out if you guys haven't already.
Appreciate it.
Let's see.
All right, should we take one or two more?
Oh, speaking of Toby Carlisle, I just heard in an interview with Toby Carlisle that Munger's Daily Journal Co. has a sizable stake in BYD. There seems to be a lot flying under the radar with Daily Journal. Thoughts?
Mm-hmm. Yeah, I did an analysis video on the Daily Journal Corporation. I think that was my last upload of 2020, actually, for memory. So about 6 months ago, just about now. Yeah, Daily Journal is interesting. There's sort of 3 parts of the business. So there is the actual Daily Journal, which is like a legal newspaper in California, I think mainly, which is basically dying. I think it brings in like $1 million a year or something, but it's kind of slowly and steadily being disrupted by technology. So there's that component of the business, which really should attribute no value at all to the investment case. There's then the stock portfolio, which, like Brad suggests, has some BYD shares in it. So one of the challenges is when you actually read a Daily Journal annual report, they talk, I think it's in the 2008 or 2009 report, about they bought some US equities and they don't disclose what it was, but you see the bank holdings and so on show up in the 13F for the Daily Journal Corporation. And then at a later date, I forget the year, but then they talked about buying I think 2 international equities, and they've never actually explicitly said in those annual reports that it's BYD or any other company. The only reason we know it's BYD is Charlie Munger has explicitly said at annual meetings the Daily Journal Corp owns some BYD stock, and there's actually some super smart people out there that have literally gone through and looked at the value of the stock portfolio and Daily Journal's quarterly reporting each quarter and tried to match that against the movements of stocks globally. I don't know how they're doing that, but somehow they've managed to kind of solve the problem and figure out that it's BYD and probably Hyundai actually was the other one that they thought was in the portfolio. So you don't see either of those stocks in a 13F, and the Daily Journal Corporation don't own a high enough percentage to warrant any other sort of filing that might show up in ticker. So that's kind of interesting. I don't know the share counts off the top of my head, but if I've got screenshots in that video, if anyone wants to check it out, that was sort of my estimate of, again, because it's not disclosed explicitly, my sort of estimate of what the holdings were in those international equities. And then the third part of the business is like this software as a service component that is basically a subscription service that courts use for, I think, like some sort of admin software. I'm forgetting some of the details, but they've signed up some pretty long-term contracts for customers in Australia and all sorts of different places, like as much as 10-year long contracts to use this software in different courthouses. And I'm blanking on the guy's name, but someone, again, you'll see links to it in the video I did, but someone has gone through and done some, Matt Peterson, that's the one. Yeah, he's done some very good analysis on trying to figure out what sort of cash flows will actually turn up, because there's a lot of these, like, say, 10-year long contracts where they're basically getting effectively no or very little revenue for the first couple of years, and then there's meant to be some fairly substantial kind of back-end revenue come through. So then you get to the whole discussion of how do you value a software as a service business with this level of revenue, and what are the margins going to be, and all that sort of stuff. So it's an interesting business, and it's one where if anyone other than like Charlie Munger and his buddies were managing it, with this little disclosure of information, I think they'd probably get grilled. But I think these guys, they let that stuff slide a little bit just because of who the people are, the kind of lack of information that comes through. But could be one to do some digging on.
Another question there from After Dinner Investor, if you want to take a stab.
Yeah, I think let's see here. What are some of the most management sensitive industries, situations, or the reverse? When do they not matter? Let's see. Go for it, Frank.
Definitely, no matter what industry or business you're looking at, management is extremely important. But I guess it just matters whether the business is simple or complex. If it's a more complex business, you really want a strong management team that know exactly what to do. Of course, you'd want management that know that industry well. So I guess some of the tech names would get fairly complex, or some of the conglomerates and things like that. And then I guess there's more simple businesses that probably don't rely on management as much. I guess even some mining type companies might not matter too much. They all know essentially what to do. They're more reliant on the macro factors of the price of whatever they're mining for. But no matter where you look, management's going to be very important. I guess it's the more complex the business is, the more important management would be. And I guess it gets a bit more sensitive on those types of businesses.
I think what the big difference, the management is definitely always important. I think the question is what type of management is most appropriate for that business, given what stage it might be in. Frankie talked about like the visionary stage. You want to have a visionary on board, someone who has a clear vision of where to go, and then they'll hire out enactors to get to that vision. But maybe once they have some traction, they have a bunch of cash flow coming in, then you might want someone like a Jack Welch, who might be more of a sort of optimizer and cutting out the fat that might have been built up over the years of growth. So I think it kind of depends on what stage the company is in. Different managers will thrive in different situations and will not do well in others. So yeah, that's my take on it.
Yeah, I agree. I think like Frank said, there's a lot of businesses where management is not that important. Like, the results of a gold miner or something are going to be far more heavily influenced by commodity prices than how good the manager is. And I think there's also a lot of like more sort of moaty businesses, if you want to describe them that way, where an idiot could run them. Like, businesses where the product or the service is so entrenched in people's lives that it would be hard to screw up, like a Coca-Cola or maybe like a Adobe or a Google or something like that.
But even if the core business you don't screw that up, it's the opportunity cost of missed opportunities that you might have by having a weak manager, a weak capital allocator. So sure, the business, like your downside risk is probably protected in a big way by those MOTI businesses, as you say.
Yep.
But at the same time, you could be limiting upside significantly if you had a really good one in there.
I think
Agreed.
price could come into it a little bit. Like if you had a extremely cheap company trading below liquidation value, like a typical net, you don't really need management to be great. There could be some other catalyst that could lead to some type of mean reversion and a good return on your investment. Of course, even in that situation, a great management team would be maybe the reason why you could buy into that net. But I guess it's not always important to have a great manager there, depending on your investment strategy and the type of business you're looking at.
Mm-hmm.
True that. Well, I think we'll wrap it up there. As a reminder to everyone, smash the like button. I don't know how many times we've said that, but if you haven't already, now's your chance. Smash that like button. It'll help us out a lot. We appreciate that. And be sure to subscribe so you don't miss future episodes. We do them it's Friday night here in Chicago. It's Saturday midday-ish for you guys in New Zealand and Australia. And then I think it's Saturday morning in the UAE where Quran normally streams from. And then it is also Friday night in San Fran, the Bay Area where Brad is from. But I think he's in the Midwest right now on his trip. So we'll be happy to have those guys back next week. And check out the Discord as well. I included the updated link in the chat, but after this video is done, I'll go ahead and change the video description as well to include the updated link in case that one's not working. So be sure to check that out as well. But otherwise, until next time, take care, everyone, and I'll see you guys next week.
Thanks, everyone.